And do AI investments pose a risk to your portfolio? Well, a recent report found that just 7 tech companies, that's Alphabet, the parent company of Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, now represent about 36% of the total market cap of the S&P 500. It's the most popular index fund in America. They're all tech companies, and they're all investing heavily in artificial intelligence. So, if the AI trade doesn't work out as planned, it could drag on your retirement savings. With us now to assess the risk is Daniel Lacalle, chief economist at the Tresses Hedge Fund, which manages over $6 billion in assets. Daniel, great to see you as always. Daniel, does the AI trade keep you up at night?
It doesn't keep me up at night. I hear a lot of very biased assessments of an alleged bubble and similarities to the 2001 tech bubble. But we must remember first that the 2001 tech bubble was not a tech bubble. Was a result of the lack of confidence after the fraud of Enron and WorldCom. Nothing to do with what is going on today. What is going on today in artificial intelligence is something completely different. It's companies that have enormous levels of cash and very little leverage, taking a very substantial bet on investments in artificial intelligence because they know that it's the future. And that is a completely different thing from, say, Enron betting on alleged earnings that would never come. This is companies that are making money today, that have enormous earnings and very substantial margins, and taking their cash and investing in something that is going to yield real economic returns. Therefore, it's not a bubble if we look at the leverage. It's not a bubble if we look at the earnings of these companies. And it's certainly not a bubble if we look at the reality of artificial intelligence, because no one is betting on something that is kind of a dream like the velociraptors of Enron. What they're betting is on something that we all use every day and are using more frequently.
How about the concerns, Daniel, that the equipment and the infrastructure that they're investing in will depreciate in value much faster than the companies are predicting? I'm sure you saw the very famous Big Short investor Michael Burry warning about this. What could that mean for potential stock price changes?
I mean, obviously, value is subjective. This is very important. And we need to understand that what is going on right now has absolutely nothing to do with what he was mentioning relative, for example, to financial companies. Everybody must understand that in technology, investment is not a safe bet. No, investing in technology is not like investing in distribution networks where you have a regulated return. You are obviously investing in something in which first mover advantage is very important, but it's also important to understand that technology investment is about creative destruction. It's going to create some other investments to yield no return. And that is not a problem when companies like the ones that you have mentioned are having record levels of earnings, record levels of cash flow generation. Let's remember that 4 of those companies have more cash in their balance sheet than the entire index of some European countries. So if we look at everything, you may think that valuations are elevated. Maybe. But now think of whether are you going to use artificial intelligence more or less in the future? Is artificial intelligence just a fad or something that is going to be implemented throughout the entire value chain of industry, services, etc.? Okay, so if you believe, like I do, that artificial intelligence is not the future, it's the present, and if you believe that the current environment is going to generate a tremendous opportunity in those investments, then the depreciation of some of those investments is going to come with the appreciation of the vast majority of these investments. Anyone understands this? Do you remember all the people that said that Facebook, now Meta, was making a very big mistake by acquiring WhatsApp? Who says that now? Nobody. This is what's important, is to understand that technology is a completely different thing from valuing banks or from valuing energy stocks.
How about some of the potential hurdles, Daniel? Say, for example, government regulation or the
Yeah.
vast amounts of energy that will be needed to power this AI revolution, for want of a better phrase.
No, absolutely. There will be hurdles. Absolutely. No technology company expects this to be an easy ride. And obviously, those are challenges that they're looking into. But we also have to remember that a lot of the mistakes that people make when analyzing a revolution is the biggest one is called presentism, which is to believe that the level of consumption of energy and the level of investment requirements of today are going to be the same forever. They made that mistake with shale. Remember when they said that it was impossible for the shale revolution to last because it consumed way too much water? Never bet against engineers. Engineers find solutions. Analysts and banks find problems. The reality is that what we are going to face in the next years is certainly regulatory challenges that will be overcome by other opportunities, and we are going to face also the challenges of those investments that will be needed. But the people that are saying that the investments are going to generate an enormous problem for these companies cannot bet on one thing and the opposite. Cannot say on the one hand that those investments will not be able to be implemented, and at the same time say that there's going to be a cash flow problem. Either they're going to implement those investments or they're not. But you cannot bet on one thing and the opposite. That doesn't make any sense to me. So I'm not saying, obviously, can there be corrections? Absolutely, there are corrections. But when we look at what is going on in markets today, the moment that the market starts to recover, it recovers with these names. And it recovers with these names because they're the ones that in net present value, in cash generation, in margins, and in growth of their underlying business, they are the ones that lead. And some people have missed it. Good for them if they think that it's a negative, they can always short it. Why don't they do it?
Dan, who you said that engineers find solutions and bank analysts find problems. That's one for the record books. Daniel Lacalle at the Tresses Hedge Fund. Daniel, as always, thank you so much.
Thank you very much. Have a good day.